If you elected S Corp status to save money on taxes, nice. For a lot of solopreneurs, that can be a great move. But here's something most people don't realize until they've been running their S Corp for a year or two. Just having the S Corp is not the strategy, it's the foundation. What you build on top of it is where the real savings happen. And right now, there are 4 specific strategies that self-employed S Corp owners have on their radar that can meaningfully reduce what you owe at tax time. Hey y'all, I'm Nikita with Collective. We help thousands of solopreneurs run their back office, and we see firsthand which strategies actually move the needle and which ones people are leaving on the table. So let's get into it. But before we do, let me just quickly set the table on why S Corps are worth talking about in the first place. Because if you're newer to this, it's worth understanding the core benefit. When you're self-employed and doing taxes as a sole proprietor, your net profit is subject to self-employment tax. Currently, that's 15.3%, and that covers your Social Security and Medicare contributions. And since you're your own employer, you're paying both the employee and employer sides of it. When you elect S Corp status, you split your income into 2 buckets. You pay yourself a reasonable salary as a W-2 employee of your own company, and you take the remaining profit as a distribution. Self-employment tax only applies to the salary, not the distributions. So if you're earning $150K and paying yourself an $80K salary, you're only paying self-employment tax on that $80K. Now you still pay income tax on all your business income, but now with an S Corp election, the remaining $70K in distributions avoids that 15.3% hit. That savings opportunity is one of the main reasons people elect S Corp, but it's just the beginning. Strategy number 1 is about timing, and it might be the most important thing on this list because it's the one that trips people up before they even get started. Make the S Corp election when you're ready, not before. Here's what I mean by that. A lot of people hear about S Corps and the potential tax savings, and they immediately think they need to go elect S Corp status right now, like today. And I get it, when someone tells you there's a way to save money on taxes, the instinct is to move quickly. But here's the thing. You actually don't have to elect S Corp status the moment you form your LLC. You can run your business as a sole member LLC for as long as you need to, and then add the S Corp election when the time is actually right for you. And why does that timing matter, Nikita? Because electing S Corp status comes with real administrative responsibilities. You have to run payroll, you have to pay yourself a reasonable W-2 salary, quarterly payroll tax filings, additional bookkeeping requirements, and potentially higher accounting costs. None of that is impossible to manage, but it's a real cost. And for a lot of new business owners, those costs can actually cancel out the tax savings entirely. Here's the other piece people don't talk about enough. S Corp savings don't exist for everyone at every income level. The self-employment tax savings that make an S Corp worth it generally start to show up meaningfully when your business is generating somewhere in the range of $60,000 to $80,000 or more in net profit. Below that threshold, the cost of running the S Corp, payroll, tax, filings, bookkeeping can easily outpace what you're actually saving. The right time to make the election is when you understand the administrative work involved, when you have looked at your actual numbers, and when there is a real clear savings opportunity on the table. Not because someone told you S Corps are always better, and not because you feel behind if you haven't done it yet. There's no prize for electing early. There's just the right time, and that time is different for everyone. Next, let's tackle your reasonable salary, because this aspect of managing your payroll is key to navigating everything else. And it's also one of the most misunderstood pieces of running an S Corp. The IRS requires S Corp owner-operators to pay themselves a reasonable salary for the work they perform in the business. And it's not optional. If you're running your S Corp and not paying yourself a salary, or you're paying yourself a salary that's way too low, you risk getting on the IRS's radar. Now, the IRS doesn't publish a specific formula for what reasonable means, but they do look at what someone with your role, skills, and industry experience would earn working for another company. If you're a graphic designer running a solo design business, your salary should reflect what a comparable designer would earn in your market. If you're a consultant charging clients $1,000 an hour, a $30,000 annual salary may raise eyebrows. Here's why this matters strategically. A lot of S Corp owners think that the goal is to make the salary as low as possible to minimize self-employment tax. And yes, in theory, that would result in some big savings there, but setting it too low can create a bigger problem. The IRS can reclassify more of your income as wages, which means you'd owe back payroll taxes, interest, and potential penalties. The downside of getting this wrong is a lot worse than the tax you'd save by gaming the number. The actual strategy here is to set your salary correctly from the start, document your reasoning, and then optimize everything else around that. Plus, your salary is flexible. You can make adjustments year-round, like skipping a payroll or running an off-cycle bonus if you need to. This protects you, and it gives you a stable foundation for the rest of the strategies we'll talk about. The IRS has some published guidance on reasonable compensation, and there are plenty of salary guides that can support your documentation. Maximizing retirement contributions has the potential to be the biggest dollar value strategy on this list, especially as your income grows, and it is dramatically underused by solopreneurs. Many people think that once you become self-employed, you just give up traditional employee benefits like retirement plans. But a one-person business can open a solo 401k, sometimes called an individual 401k or a self-employed 401k. Here's how the math works. As an employee of your own S Corp, you can contribute up to $24,500 to a solo 401k as an elective deferral. That's the employee contribution. If you're 50 or older, you can add a catch-up contribution on top of that. And then your S Corp can also make an employer contribution of up to 25% of your W-2 compensation. Combined, the total contribution limit currently is $72,000 if you're under 50. With the number increasing if you're over 50. Every dollar you contribute to a traditional solo 401k reduces your taxable income. So if you max out your solo 401k, we're talking about thousands of dollars in potential tax savings in a single year. Not to mention the long-term compounding benefit of the retirement savings themselves. Employer contributions can generally be made up to the tax filing deadline, including extensions, and the plan needs to be maintained properly, which means working with a financial institution that offers solo 401k plans and understanding the record-keeping requirements. The IRS website has current contribution limits updated annually. Deducting your health insurance premiums is straightforward but consistently missed or misapplied, so it's worth covering clearly. If you're a more than 2% shareholder of your S Corp, which as a solopreneur you almost certainly are, you may be able to deduct your health insurance premiums as an above-the-line deduction on your personal tax return. Now that means it reduces your adjusted gross income, which has downstream benefits beyond just the direct tax savings. Here's how the mechanics work. Your S Corp pays your health insurance premiums or reimburses you for them and includes that amount in your W-2 wages as compensation. You then deduct those premiums on your Schedule 1 of your personal 1040. The net effect is that you get the deduction without paying income tax on the premium amount. This also extends to premiums for your spouse and dependents. And if you have a qualifying high deductible health plan, you can layer on an HSA contribution health savings account on top of this, which gives you yet another tax advantage bucket. Contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. The setup here matters though. The premiums need to be paid or reimbursed by the S Corp, not just paid personally, and they need to show up correctly on your W-2. If this isn't set up right, the deduction can be disallowed, which is a common and entirely preventable mistake. Whew. Okay, I know that was a lot, so let's bring it all together, because running an S Corp with just the basic payroll setup is like buying a high-performance car and only driving it in first gear. The S Corp election itself gives you the opportunity for self-employment tax savings, but the strategies that layer on top of it, getting your salary right, taking advantage of a solo 401k, and correctly deducting your health insurance are where the real optimization happens. None of these are loopholes. They are legitimate IRS-sanctioned strategies that are available to you as a self-employed business owner. The difference between business owners who use these strategies and those who don't is usually just having the right information and support system. Here at Collective, this is the kind of thing we think about all day, every day, y'all, on behalf of our members. Setting up the entity correctly, keeping the books clean, and making sure payroll is handled right means you're not scrambling or guessing if you're overpaying come tax season. If you found this helpful, be sure to give it a thumbs up and subscribe for more content like this. And if you're a solopreneur and there's a business topic that you want us to tackle, let us know down in the comments. We'll see you next time. Bye.